Starbucks stock. Is it going to be smooth and uplifting, or taste burnt and end up spilled out into the sink? We're building a model for Starbucks, which is going to have multiple components. Each of those components are going to end up resulting in what's called an intrinsic value, our estimation of what the stock is really worth. If that's higher than what it's currently trading at, then we will buy the stock. Let's rock. All right, so we're ultimately building a three-statement financial model. We're going to start out right here with the balance sheet. So when we look first at cash and cash equivalents, we see an uptick in 2020 as well as 2021. But something to remember, this particular company, they had a lot of cash, almost $9 billion in 2018. They ended up repurchasing a lot of stock, and that probably wasn't so smart because they needed that cash later on. So one of the things that we have to look at is what are the types of corporate decisions that a company makes along the way? And this is something that we have to keep an eye on a going forward basis. Stored value card liability. When you get a gift card at Starbucks or any store, let's say it's $100. So you have 100 increase in cash, 100 increase in that store liability for that card. Now, what happens when you go use that card? That is when the sales are recognized. So what's going to happen is sales increases net income, which increases retained earnings. So you're going to have retained earnings go up 10, store value card liability go down 10, and the balance sheet will balance. Moving on to our next line item, debt. Very important to understand a company's capital structure and how they treat that. In this particular case, Starbucks had a pretty big increase in their debt in 2020. Obviously, rates went down pretty significantly, but I want you to understand there's absolute and relative changes, and this on an absolute basis doesn't seem like much. It's like 5 billion. But when you think about it on a relative basis, it's pretty massive. You're going from 11,167 to 16,348. That's going to be about a 50% increase in debt. So something that we need to be aware of. Now, fortunately, this debt was at very low rates, which is fantastic for us as investors. But in the end, we have to consider what is going to be the trajectory of that debt on a going forward basis. We don't want to see that continue to creep up, and we don't want the company to be heavily debt dependent. On to our next statement, which is the income statement. The income statement consists of revenues and expenses and culminates in net income. We obviously want to see revenues increasing, we want to see net income increasing, and we want to know that the company has control over its expenses. Let's check it out. What we really want to do here is look at trends. And what we see is positive trends for Starbucks. They're expanding internationally and doing a very good job with that. But a few things to be mindful of and aware of. Obviously, with COVID, a real downswing in revenues, but it has ripped since. The company has a pretty significant international expansion strategy. Right now, about 75% of their revenues are based in North America, 25% internationally. They're really expanding internationally in an aggressive fashion, and that's where the bulk of their growth is coming from as a company. We look at cost of goods sold. Obviously, for a company that's basically selling coffee cups, and little pieces of food and stuff like that, you're going to have a very significant amount of inventory. So their cost of goods sold, which is the expensing of inventory, ends up being pretty high as a result. All right, next we're going to cover the cash flow statement, our third statement. That's the combination of operating, investing, and financing cash flows. When we combine those three items together, the result is the net change in cash. We obviously want to see that the company is increasing the amount of cash that they generate over time. Let's check it out. A few things to note here. Obviously, with COVID, you see this massive decrease in net income. And I have these other areas in orange just so we can focus on them. So when you see this massive decrease in net income here, it should definitely raise up your antenna and raise a little bit of a red flag, because what you see is they basically lose 75% of their net income. But remember, they still have dividends that they have to pay to the tune of 1.9 billion, which we see right down here. They also had 1.7 billion of share repurchases. So where's that money going to come from if you don't have that net income? That comes from issuing debt. So they issued about $6 billion worth of debt. The positive, though, is at very low rates. It's at about 3.55%, which is super, super low. So very smart, but what's going to happen when you refinance that debt as rates go up? Obviously, your rates are going to go up as well. So something that we have to think about and consider on a going forward basis. If we look at cash from operations relative to cash from investing, we see that there's a gap, which is good. We want to see that change increase over time. We want to see more cash from operations relative to cash from investing. That is effectively free cash flow. So when we look at that, we see that it's increasing over time at a pretty good clip. And on a relative basis, it appears that the cash from operations is increasing at a faster rate than the cash from investing, which is exactly what we want to see. They're being more efficient with the money that they're reinvesting into the company. Now that we finished the cash flow statement, we're going to move to our forecast numbers and drivers. The reason that they're called drivers is they drive the numbers into the future. Basically, they're going to give us our projections. And it's very important that we look at the historical numbers to come up with some smart numbers to project the numbers on a going forward basis. By the way, guys, if you like this video, please smash that like button. So I'm going to pop into my note here and I look at what I chose for revenue growth. So we see the average excluding COVID 9.9%. It's been a nice upward trend the last couple of years. And the 2024 guidance, which was given by management, was 10 to 12%. So I ended up going on the lower end of that, being more conservative. And just to be clear, when I say conservative, what I mean is we want to be lower on revenues and higher on expenses. At the end of the day, whatever answer we have fall out of this model, we're either going to buy the stock or not buy the stock based upon it. So I want to use very conservative assumptions so that I'm very confident in the answer that we get. Moving on to cost of goods sold, I had mentioned this earlier because of the very heavy amount of inventory, right, cups, coffee, etc., that this company has. We're going to have a pretty high cost of goods sold as a percentage of revenue. The good news is it's fairly stable. So we see average ex-COVID 73.3, 3-year average 73.7. So I ended up going with 74%, a little bit higher to be conservative there. G&A, which stands for general and administrative, that's basically overhead costs. So think of things like salaries, insurance, utilities, stuff like that. It's not directly related to the production of the good or service that the company sells. So when we look here, the average excluding COVID, 6.7%, 3-year average, 6.6%. So being conservative, going a little bit higher, we go with 7% on that one. D&A as a percentage of revenue. So remember, D&A is the expensing of property, plant, and equipment. So it's not really directly tied to the sales function per se. And also this is going to be added back from a cash flow perspective. So we do have to be careful with this. If we go higher on this, it's actually not conservative because it gets added back later for cash flow purposes. So we want to go a little bit lower on this. So the average excluding COVID was 5, 3-year average 4.7. So I ended up going with 4.5%. The effective tax rate, now this one's very interesting because the marginal tax rate in the United States is 21 for corporations. So I dug into this and went to the notes for the company. And although the marginal federal tax rate is 21%, they also are subject to state and foreign taxes that end up being about another 3 to 4%. So that comes up to a total of about 25%. So that was the number that I went with. Coming down to capital expenditures. So remember what capital expenditures are? That is the amount that gets reinvested into the business. That's what they're doing. They're buying property, plant, and equipment to expand and grow for the future. Now, one of the interesting things that we see here is looking back, we see the average excluding COVID was 6.4%, 5-year average 6.1, 3-year average 5.8. So some of you might be saying like, bro, why'd you go with 7.5%? There is a method to the madness. So management guidance, they said in 2024, they're going to have $3 billion of capital expenditures. When I look at the projected revenues, $3 billion over the projected revenues actually works out to be about 7.5%. So I want to be in line with what management says. This is where you have to understand there's an art versus a science of financial modeling. The art is understanding what's being said and what's going on in light of the environment. The science is just look at the numbers, plug and chug, average, be robotic. So we look right here, we see that the company said they expect CapEx 2024 of approximately $3 billion, and over 85% is going to be directed to the global store portfolio. Next, we're going to move on to the cases. If we come down here, we see the cases that I chose. I have a bull case, which is an upside case, a bear case, which is a steady state case, and a base case. So this case that we have right here is actually the base case. All right. That's the most likely scenario that's going to occur or happen for the company. So what I did was the numbers that we have running currently in the model is set to the base case. I then had an upside case, which means revenues go up and the expense items go down. And then we have the bear case where the revenues go down and the expense items go up. If you're liking this, subscribe to the channel and also share it with your friends. Appreciate that. So next thing we have to cover is the DCF assumptions. What are the different pieces of that? Basically, these are the assumptions that we're going to use to take those projections and bring them back to today. So it's very important that we go through these assumptions. We're going to come up with our discount rate, which is our weighted average cost of capital. And that's how we're going to take these future cash flows, discount them to today so that we can get a current value. So we have the risk-free rate. I grabbed this from Yahoo Finance. SBUX is the ticker. We have a 5-year financial model, so we use a 5-year risk-free rate, about 4.02%. Beta signifies risk. So the higher the beta, the riskier the stock is. Very simply, I went to multiple sources: Yahoo, Zacks, MarketWatch, Guru Focus, and FinViz. The average from those sources was 0.98. So I went a little bit higher to be more conservative, went with a beta of 1. Market risk premium from our boy Demoteran over at NYU, 4.57. So we get a cost of equity, which is the capital asset pricing model, risk-free rate plus beta times the market risk premium. That comes out to about 8.6%. Now, you know, I mentioned earlier that the company has a super low cost of debt because they issued a bunch of debt during COVID at very low rates. So the pre-tax cost of debt, that's the amount that they would have to pay if they raise debt today. Now, a few things to understand here. One, the risk-free rate, that is the rate that is paid by the United States government on any new debt that it issues. So there's no way that a company could have a lower cost of debt than the United States government. It's just not feasible because the US government, if things go bad, they can print more money. Starbucks can't print more money. So we know that we have to have a cost of debt that's greater than the risk-free rate. Their actual weighted average cost of debt comes out to 3.55%. But if they were issuing new debt today, it would have to be at a higher rate. So what I did was I looked at the credit rating. The most recent credit rating was from S&P. It was BBB+, stable outlook. That was in November, so not that long ago. And if we apply a spread based on that rating, we end up getting a spread of 1.47% that gets added to the risk-free rate. So that is their pre-tax cost of debt. Remember, we talked earlier about that 25% tax rate. So the post-tax cost of debt, we get 4.12%. So we have debt and equity as a percentage of total capital. We get a weighted average cost of capital of a little more than 8%. We look at the current share price, 93.07. That is what we're going to be comparing our DCF valuation to. Moving on, we come down to here, a few things to note: cash and cash equivalents. So the company includes short-term investments in their cash and cash equivalents. So something to be considered cash has to be highly liquid and be able to be sold for 100 cents on the dollar if it is invested somewhere. So they actually include their short-term investments in their cash and cash equivalents. The reason being, their short-term investments are highly liquid, things like treasury bills, commercial paper, stuff like that. So they're able to include that in their cash. So I just want to mention, if you look at that discrepancy, which is about $400 million, that's why the difference there. Terminal growth rate tends to range from 0 to 3%, went with 2%, but in this particular model, I chose to go with a terminal EBITDA multiple. Now, the company is currently at 17.2 times, but if you look at their competitors, McDonald's, Yum, and Restaurant Brands International, and their current TEV to EBITDAs, you get an average of 17.8%. What this is called is a comps analysis, or looking at comparable companies and seeing how they trade. So logically speaking, if a company is very similar to another company, they should trade at the same level because on a relative basis, the market is fairly efficient. And if there were dislocations, those would be exploited by hedge funds and other savvy investors. All right, let's move on to our DCF valuation. Woo woo. This is the moment that we've all been waiting for. So ultimately, what we're going to do is we're going to calculate the unlevered free cash flows. We're going to discount those back to today. We're also going to calculate a terminal value, discount that back to today, combine all of those into what's called a total enterprise value. That's the value of the firm to both debt holders and equity holders. We start out with net income, but the problem is net income already has interest taken out. So we have to make an adjustment, and that's the adjustment that we're making right here. So instead, what we're going to do is we're going to start with EBITDA. We subtract out D&A, depreciation and amortization. That gives us EBIT. Then we tax affect that. So what we're going to do is we're going to strip taxes out of that. We get EBI, which is earnings before interest, but it's after taxes, hence EBIT. or NOPAT, net operating profit after taxes. So instead of starting out with net income, which has interest stripped out of it, we start out with EBITDA or NOPAT, which has the interest baked into it. Then what we do is we strip out all the remaining operating cash flows and the investing cash flows, specifically capital expenditures, that reinvestment into the business. We calculate the FCFF, free cash flow to the firm, which is unlevered free cash flow. We then come up with our terminal value, which is the value of the company from the end of the model out into infinity. When the model finishes, the company doesn't go out of business. What ends up happening is it keeps functioning, but we just can't keep bringing the model out further and further. What we're going to do is we're going to say, okay, what is that stable cash flow, that normalized cash flow? And then what we're going to do is we're going to take that and multiply that out so that we can get that terminal value, which is going to be the value from the end of the model out into infinity. So we end up having EBITDA times 17x gives us 187. So we end up adding that together and add all of the precedent cash flows together as well. We also utilize the discount factor. So the discount factor is the value of those future dollars in today's dollar terms. So $1 a year from now is worth 93 cents on the dollar. $1 5 years from now is worth 68 cents on the dollar based on the risk of StarBucks, which is that 8% weighted average cost of capital. We multiply those out. What this is doing is taking those future cash flows and making them today cash flows. It's basically the present value of those cash flows. So next, what we're going to do is cover the valuation itself. So if we look over here to the left, we have a few different components here. So when we add together those cash flows, what we're going to get is about $135.8 billion. All right, pretty significant. We're going to strip out the debt. We're going to add the cash. We're going to strip out non-controlling interest. That's basically interest that other companies have within StarBucks. So we have to strip those out. We do add associate investments. That's effectively investments that StarBucks has in other companies that are not going to be reflected in their cash flows. So we add those in. So we take total enterprise value, less debt, plus cash, less non-controlling interest, plus associate investments. We get an intrinsic equity value of $124.8 billion. But what does that mean? Well, what we have to do is we have to take the shares outstanding to get a per share intrinsic value. So we have the shares outstanding, 1136.7. We get an implied share price of 109.79, almost 110 bucks a share. The current share price as of yesterday's close, 93.07. That gives us a discount of 18%, which comes to a hold rating. Now, this is very important. The way that we determine whether something is a buy, sell, or hold is as follows. If it's greater than 20% discount, that would be considered a buy. If it's between 0 and 20%, that would be considered a hold. And if it's selling at a premium, we don't want to buy something for more than it's worth. Therefore, that would be a sell. So in this case, it's a hold, but it's very, very close to actually being a buy. It's 2% away from being a buy. So right now at 93.07, I would say if it gets below 90, high 80s, that's when it would be a little bit more interesting. It's very, very close, but ultimately right now we would consider this a hold. Okay, so when you build a financial model, one of the questions that always comes up is, what do we do next? Well, you're not going to build 100 different models. What we're going to do is we're going to conduct what's called a sensitivity analysis. What that does is give us many different potential results if and when we went ahead and changed the actual assumptions. So rather than creating 100 different models, we can create one model and utilize sensitivity analysis so that we can generate many different results. We're going to have the equivalent of running 25 different models in one fell swoop. Now, how does that happen? Basically, what you do is you run what's called a data table. The center number, you'll notice the 109.79, that center number matches what we currently have as our intrinsic value in the model. And what we see is that if we run that bull case scenario, it's obviously a buy. If we run that bear case scenario or that downside scenario, it stays a hold and might even become close to a sell. So this is super helpful. You see the discount to the intrinsic value on the right side over there. And effectively what that's doing is that's giving what the actual discount is to the intrinsic value based upon the value that falls out of the model over on the left-hand side. So you can see this pretty vast range here, and it gives you a good idea and understanding if we ran a bunch of different models based on these assumptions, what the ultimate results would end up being. All right, next we're going to move into the scenario analysis. So whereas sensitivity analysis looks at one or two variables and changes them, a scenario analysis is going to look at many different variables and change all of those based on a best case, worst case, or most likely scenario. What we can then do is weight those results to come up with a weighted average valuation. That way, we kind of look at the best, the worst, and the most likely, and we come up with a valuation based upon that. Let's check it out. So if we come down here to the scenario analysis, what I basically did was I ran the model at each scenario, the bear case scenario, the base case, and the bull case. And what I did was I said, you know what? There's an equal likelihood of each scenario. Not one is more likely than the other. So we have a 33% probability for each one of these cases. And that gives us, ironically, a sell in the case of the bear, a buy in the case of a bull, and a hold, which is our current case, the base case. If you do a weighted average of those, basically you do a sum product, you say there's a 33.3% chance multiplied by the intrinsic value per share, add those all together, we actually get 110.71, so a little bit higher than what our current intrinsic value estimate is. So we get a discount of 19%, which is still a hold, but it's very, very close to a buy. And ultimately, how you want to think about this, if you currently own Starbucks, you would hold it in your portfolio. You wouldn't sell it. If you didn't own Starbucks, you would still be watching it very closely and consider adding it into your portfolio when it becomes a little bit more of a discount. Now, the exception is if you had something else in your portfolio that were at a bigger discount, you might want to allocate more capital to that idea rather than Starbucks. But Starbucks is very, very close. I would say this would be something to monitor that you want to consider on a going forward basis to include in your portfolio. All right, guys, thanks for joining me today. I really hope that you found a lot of value with that Starbucks model. Remember, I am not a financial advisor. This is just my gift to you going through the Starbucks stock analysis. So make sure you do your own diligence, you do your own analysis before you decide to buy or sell any security, but in this case, especially Starbucks. If you did find that valuable, I want you to check out a model that I built on Tesla. This one is very similar in terms of the rigor and the analysis, but I think you'll find it really helpful and valuable if you enjoyed this video. As always, please make sure you tune in for more content, so subscribe. And if you enjoyed this, please share it with your friends. I look forward to seeing you next time, guys. Be relentless.